If you're in the United States and lucky enough to have a defined benefit pension plan, you are literally holding a winning lottery ticket, one that pays out in installments for the rest of your life. But tragically, every single day, I see retirees tear this ticket up simply because they don't understand what they actually own. Think about it. You've worked for decades. You've traded your time, your energy, and your youth for a corporation or a government, and this pension is their debt to you. It's what they owe you. Yet, one simple miscalculation about interest rates, one misunderstanding of survivor benefits, or one emotional reaction to a big, shiny lump sum offer can destroy a legacy that took 30 years to build. I've seen it happen. I've seen retirees take a lump sum payout because they wanted to buy a vacation home, only to find themselves completely out of money at age 85. I've seen widows forced to sell their family homes because their deceased spouses chose the single life payout option. Why? To get a slightly higher monthly check. But that choice left the surviving spouse with absolutely zero income the moment the funeral was over. So in this video, we're going to deconstruct the architecture of your pension. We're going to look at the mathematical reality of lump sums versus monthly annuities. We'll explore the often overlooked threat of inflation eroding your purchasing power. And we'll dive into the critical interplay between your pension and your Social Security benefits. By the end of this, you will have the clarity to turn that lottery ticket into a fortress of financial security. The truth is, pensions are becoming an endangered species, especially in the private sector. If you have one, you are a financial unicorn. Most people today only have a 401k, which puts the entire burden of market risk and longevity risk right on their own shoulders. If the market crashes the year they retire, they're in serious trouble. If they live to be 105, they might run out of money. But you, with a pension, you have a safety net that removes that weight from your shoulders. As long as you do, uncut the ropes yourself. The single biggest mistake I see is people viewing their pension in a vacuum. They look at the monthly amount, say $3,000, and they just mentally add it to their bank account. They don't consider how it fundamentally changes their entire investment strategy. They don't realize that a pension is essentially a massive, invisible bond portfolio. It's a fixed income instrument. If you just treat it like another paycheck, you miss a huge strategic opportunity to be more aggressive with your other assets, or to build a legacy plan that could literally change your family's financial trajectory for generations. We need to stop looking at the pension as just mailbox money and start treating it as the cornerstone of a complex, powerful financial structure. Let's start with the biggest temptation, the lump sum offer. Your company might present you with a choice. Take, say, $500,000 today, or get $3,000 a month for life. That $500,000 number looks huge, doesn't it? The visions of a new boat, a new car, or paying off the mortgage dance in your head. But let's do the math. To generate $36,000 a year from a $500,000 portfolio, you would need to achieve a 7.2% withdrawal rate year after year without ever touching the principal. In a volatile market, that is a monumental task, and the risk of running out of money is very, very real. The pension, on the other hand, is a guaranteed paycheck. It's a promise, backed by the company and often insured by the government. It's a transfer of risk from you to them. Now, let's talk about survivor benefits. This is where I see the most heartbreaking mistakes. When you retire, you'll be given options like single life or joint and survivor. The single life option will always have a higher monthly payout. For example, it might be $3,200 a month for you alone versus $2,800 a month for both you and your spouse. Many people get greedy. They see that extra $400 a month and think about what they could do with it. But they're not thinking about what happens if they're the first to pass away. Choosing single life means the pension dies with you. Your spouse gets nothing. That extra $400 a month is a gamble, and you're betting against your spouse's future financial security. Is it really worth it? For most people, the answer is a resounding no. The joint and survivor option is a profound act of love and protection. Finally, you can't ignore inflation. A $3,000 check today feels great. But in 20 years, what will that $3,000 actually buy? If your pension doesn't have a cost of living adjustment or COLA, your purchasing power will get chipped away year after year. This is why it's so important to have other investments. Like a well-diversified stock portfolio in your IRA or 401k, it can grow faster than inflation and supplement your fixed pension income. Your pension is your foundation. It's the secure base that allows you to take calculated risks elsewhere to ensure your lifestyle keeps up with rising costs. Your pension isn't just a monthly payment. It's a strategic asset. It's a guarantee in an uncertain world. Let's talk about pensions and a simple trick to understand what your pension is actually worth. You see, our brains are not wired to appreciate a steady stream of income. A monthly check for, let's say, $2,500 feels nice, sure, but it doesn't exactly scream wealth. But what if you had to buy that income stream on the open market? If you went to an insurance company today and said, "I want an annuity that pays me $2,500 a month for life," starting at age 65, you'd have to write them a check for over $500,000. That's the real value of your pension. It's like having phantom equity. You don't see that $500,000 balance, but trust me, it's there. When you realize you're effectively walking around with a $500,000 or even $1 million bond portfolio, it should completely change how you see your 401k or your IRA. This is what we call the floor and upside strategy. Your pension, along with Social Security, creates a solid floor. It's the concrete foundation that guarantees the lights stay on and you'll always have food in the fridge. With that foundation in place, your investment portfolio can become your upside. It's your hedge against inflation, your travel fund, the money you leave to your grandkids. Because your basic needs are covered by this bond, you can afford to be more patient and perhaps a bit more aggressive with your other investments. You have a luxury that a retiree without a pension simply doesn't have. Now this brings us to the big, agonizing decision every pension holder faces: taking the lump sum versus the monthly annuity. This is the choice that keeps people up at night. Corporations love to offer you a lump sum. They'll send you a glossy packet offering you, say, $600,000 to just walk away from your $4,000 monthly check. Why do they do this? It's not out of the goodness of their hearts. They're doing it to get a massive liability off their books. They are literally transferring all the risk from their corporate balance sheet directly onto your kitchen table. Now, sometimes taking the lump sum makes sense, but you have to understand what you're getting into. When you take that big check, you're making a bet. You're betting that you can invest that money and get a better return than the pension was offering. You're also betting that you won't panic and sell when the market inevitably drops 20%. I remember a story about a gentleman who retired from a big telecom company back in early 2000. He took his lump sum, about $800,000, because he was absolutely convinced he could make 10% a year in the stock market. He rolled it into an IRA, and then the dot-com bubble burst. Within 2 years, his portfolio was cut in half. He went from a guaranteed, comfortable retirement to bagging groceries in his 70s, all because he took on market risk he didn't need to. But there's another side to this coin. There's a risk in trusting that guaranteed pension. Think about the pilots at United Airlines or the steelworkers in the Rust Belt. We often think guaranteed means risk-free, but corporate bankruptcies happen. When major airlines filed for bankruptcy in the early 2000s, many pilots saw their pensions slashed. So, if you're a high earner expecting a huge pension and your company goes under, you might only get a fraction of what you were promised. This is called counterparty risk. If you're working for a company that's on shaky financial ground, taking the lump sum might actually be the safer move. It allows you to secure your capital before the ship goes down. It's a darker side of financial planning that is often overlooked, but it's critical. You have to assess the financial health of your employer just as carefully as you assess your own. It's a complex decision with no single right answer, but understanding both sides is the first step to making the right choice for you. Let's talk about the silent killer of your retirement dreams: inflation. It's the one variable that can completely wreck the math for anyone planning a long and happy retirement. You see, most corporate pensions are not indexed for inflation. That means the $3,000 monthly check that feels like a comfortable income on your first day of retirement will feel like you're barely scraping by 20 years later. Think about it. If we use a normal historical inflation rate of about 3%, the actual purchasing power of your money gets cut in half every 24 years. So, if you retire at 60 and you're lucky enough to live to 84, your pension check buys half the groceries, half the gas, and half of everything else it used to. This is a huge problem, and you can't just ignore it. This is where a smart strategy comes into play. You can't rely on a fixed pension to cover your ever-increasing lifestyle costs forever. You need to be proactive. Your IRA and brokerage accounts aren't just extra savings. They need to be structured specifically to act as an inflation shield for your pension. Here's how it works. In the early years of your retirement, say from age 60 to 75, your pension should comfortably cover most of your bills. This is great because it allows your investment accounts to stay invested and continue to grow, hopefully outpacing inflation. But in the later years, as the cost of living rises, your pension's value shrinks. That's when you'll start to draw more heavily from your investments, not as a luxury, but just to maintain the same standard of living you're used to. This is also why you sometimes hear the advice to roll your pension into an IRA. It's not just about having more control over your money. A well-managed investment portfolio has a much better chance of keeping up with, or even beating, inflation than a fixed corporate check that's frozen in time. It's about giving your money a fighting chance to grow over the long term. Now, let us get into the most emotional and irreversible decision you'll make in this entire process: survivor benefits. When you're ready to retire and you sit down to sign those pension papers, you'll be faced with a menu of options. You'll see single life, which offers the highest monthly payout. Then you'll see options like 50%, 75%, or 100% joint and survivor, which pay less per month but continue to pay out to your spouse after you're gone. The temptation to take the single life option is enormous. That higher monthly number just jumps off the page. You might think, I'm healthy. My spouse has their own savings. We need the maximum cash flow right now. Please, be careful. This is a classic trap. I want you to close your eyes and imagine a scene. Your spouse is sitting across from a funeral director making the arrangements for your service. In that moment of immense grief, they get a call and find out that their monthly income has just been cut by 60%, or maybe even to zero. That is the cold, hard reality of choosing the single life option. Unless your spouse has a massive, independent retirement fund of their own, choosing single life is essentially betting your spouse's financial survival on the chance that you will outlive them. It's a gamble you don't want them to lose. Now, some financial advisors might pitch a sophisticated strategy called pension maximization. The theory sounds great on paper. You take the highest single life payout, and then you use that extra money to buy a big life insurance policy on yourself. The idea is, if you die, the insurance payout replaces the lost pension income for your spouse. And if your spouse dies first, you can just cancel the insurance and keep the higher pension. It seems clever, but in reality, this strategy is loaded with risks. I've seen it backfire badly. What happens when the insurance premiums skyrocket as you get older? What if you forget to pay a premium one month and the policy lapses without you realizing it? Suddenly, you're left with a single life pension and no insurance backup, leaving your spouse completely exposed. This strategy requires surgical precision and often ends up benefiting the insurance agent more than the retiree. So what's the answer? For 99% of people, the best path is the simplest one. Taking the joint and survivor option directly from your pension is the safest, most efficient, and cheapest form of life insurance you can buy for your spouse. It guarantees their security without any medical underwriting, no monthly premium checks to remember, and zero market risk. It's a promise baked right into your retirement. Protecting your pension from inflation and protecting your spouse are two of the most important things you can do for your family's future. We also need to discuss the tax torpedo. This is a concept that catches so many pensioners completely off guard. You see, your pension income is taxed as ordinary income. It's not a capital gain, and it's definitely not tax-free. It stacks right on top of your Social Security payments and your required minimum distributions, or RMDs. Now, imagine this scenario. You've got a generous pension, a healthy Social Security check, and a large 401k that you're forced to start withdrawing from at age 73. All of a sudden, you can find yourself pushed into a much higher tax bracket than you ever expected during your working years. You might even trigger what's known as IRMAA surcharges, which are basically extra taxes you have to pay on your Medicare premiums. This is a huge, expensive surprise for many retirees. This is exactly why tax planning with a pension has to happen long before you retire. It's not something you figure out after the fact. For many people, it might make a lot of sense to do Roth conversions in your 60s. Yes, this means intentionally paying some taxes early, but the goal is to reduce the size of your traditional IRA. That way, when those RMDs hit later in life, they don't combine with your pension and Social Security to completely drown you in taxes. It's all about smoothing out your tax liability over your lifetime, rather than letting it explode in your 70s and 80s. Next, let's talk about another critical angle, the gap strategy. This is a powerful way to use your pension to your advantage. So many people rush to claim Social Security at age 62, often because they're afraid of running out of money. But if you have a pension, you have a bridge. You have a steady stream of income. You can use that pension income to fund your life from, say, age 65 to age 70. What does this do? It allows your Social Security benefits to grow by a guaranteed 8% per year. That's a guaranteed return you simply cannot find anywhere in the stock market. By leaning on your pension and maybe a portion of your savings in those early retirement years, you're effectively supercharging your Social Security. Then, at age 70, you turn on that maximized Social Security check. Think about it. Now you have a maximized government check and a corporate pension. You've created this double-barreled stream of guaranteed income that makes you nearly invincible against market crashes and the risk of outliving your money. This level of coordination is the real difference between just a good retirement and a truly great one. But what about the lump sum option? It's not always the villain it's made out to be. There are specific situations where taking the lump sum is the right move. If you're in poor health, if you have a shortened life expectancy, or if you're single with no heirs who need income protection, the lump sum can be a blessing. It allows you to capture the full value of that asset right away. You can then pass it down to your children or a favorite charity. A standard pension, on the other hand, usually dies with you or your spouse. So, if legacy is your number one goal, if leaving money to your kids is more important to you than guaranteeing your own income for life, then the lump sum is the superior tool. A pension check cannot be inherited by your children, but an IRA that you rolled over from a lump sum absolutely can. This is where personal finance becomes truly personal. The math might point in one direction, but your heart and your unique life goals might point in another. For example, if you have a child with special needs who will require financial care long after you're gone, securing that lump sum in a special needs trust might be infinitely more valuable than getting a monthly check for yourself. You also need to check for a COLA, or cost of living adjustment. Some government pensions, like those for federal employees or teachers, often include a COLA. This is the absolute gold standard. A pension that grows with inflation is the most valuable asset in the entire retirement world. If you have a COLA-adjusted pension, the argument for taking a lump sum almost completely disappears. There is practically no way you can replicate a safe, inflation-adjusted income stream in the private market that can compete with a government pension. If you have one of these, you need to hold on to it with both hands. Do unknowingly. Let a salesperson talk you into rolling it over into a variable annuity or some managed stock account. The fees alone on those private investments will destroy any chance you have of beating the government guarantee. Now for a final, often ignored aspect: the non-financial benefits that are sometimes tied to your pension. In many companies, staying in the pension plan is your ticket to keeping your subsidized retiree health insurance. Thinking they were being clever, only to get a letter a month later. The letter says that because they are no longer participants in the pension plan, they are then thrown onto the ACA exchanges or forced to buy expensive private insurance until Medicare finally kicks in. You're being asked to act as your own actuary, your own investment manager, and your own risk officer all at once. You only get one shot at making this decision. Once you sign the papers and the payments begin, or that wire transfer for the lump sum is sent, you cannot call the HR department and say, "I've changed my mind." It is completely irrevocable. This permanence demands your respect. It demands that you sit down with your spouse, look at your budget, stress test your portfolio against a potential recession, and ask the hard questions about longevity and your legacy. Ultimately, the goal isn't just to have the most money, it's to have the most life. A pension that covers your basic expenses gives you the freedom to stop worrying about the stock market ticker and start focusing on your grandchildren, your hobbies, and your health. It is the backbone of a worry-free existence, but only if you secure it properly. Don't let the allure of a huge lump sum blind you to the safety of guaranteed income. But at the same time, don't blindly accept the income if your company is sinking or your health is failing. Nuance is everything in this decision. Subscribe to the channel for more deep dives into retirement income. And always remember, clarity is the best investment you can ever make. Go be confident in your financial future. Thanks for watching.